there is a difference between investor that invest into the economy of the global world compared to investor who is investing based on whatever opportunity they smell. You know, whether there is an opportunity in China, oh, then I should put more money in China, and there is opportunity in Indonesia, then I put more money into Indonesia. So this is totally two different investment style. So if you belong to the second category that I mentioned just now, then chances are you need to understand very well. Biden, is he going for by-election, the re-election? Will Donald Trump still be able to run? Will Donald Trump win or Biden win? And what will be the economic policy of Biden? Who will he appoint as maybe Secretary of Treasury? Who will he appoint as the Federal Reserve Chairman? So this second category, as you can see from now, the second category of investment style require a lot of knowledge, a lot of monitoring, and sometimes also need to get some insight that somehow you and I will never get. Honestly, I do not have an answer to any of this situation. It's just too complex. So that's why Whitman advocate a different strategy. We are not very ambitious to achieve 30-40% return by hitting on the right investment. Instead, we know that the global equity market can give us about 7 to 8% compounded over the long run. We get to bear some correction along the way, but we know that if we hold it long enough, 10 years, 15 years, 20 years, or even 30 years, we will be able to get this kind of return. So our investment strategy is to make sure that whatever that we invest will have some portion of investment in the US economy, some portion in the China economy, some portion in the Southeast Asia economy, some in Hong Kong, some in Middle East. Basically, we just want to make sure when the global economy continues to grow, there is a fair share to our investor. In between what happened and what action, what policy change, that is quite minor compared to the big picture investment strategy that we have got. Unit trust is just a word investment vehicle. It depends on what asset class that you invest into. Assuming that you are investing into a unit trust investment portfolio that invests globally, well diversified globally, I would think that you should have a time frame to invest for longer term, 5 years, 10 years, even 15 years. Okay, then only you'll be able to ride on the trend that I talk about, that global equity market continue to grow in the long run. Having said that, I do not mean that for the next 5 years or 10 years you do not review your unit trust fund, you do not evaluate the individual performance of unit trust fund. Yeah, what I mean is that if you were to put 100,000, you should keep the 100,000 be invested for 5 years, 10 years, 15 years, or even 20 years. But you should continue to monitor the unit trust fund that you have got in the portfolio. If the particular fund not perform, you may want to research again, find another better replacement to replace this underperforming fund. Okay, so this process got to continue, and in between there is a profit being made when market become very hot. You may want to take some profit, okay, and park into somewhere safe, and so that when market crash or market correct, you'll be able to use the profit to buy at the low point. So there are some best practices, some strategy to do when you invest this money for 5 years or 10 years. Okay, so the last thing you want to do is that you invest into a portfolio like this, you have a good strategy in place. After half year, all market drop, your investment portfolio also drop, then you say that, I think I'm losing money, I should get out of this portfolio. So by doing so, I think it is defeating the whole purpose of investing, because you're not following the rule of the game. Okay, in this world, in this life, when we want to do anything, we want to win in anything, we must follow the rule of the game.